Let's get into taxation. And first thing is the most misunderstood, one of the most misunderstood aspects of U.S. taxation. It's called the foreign earned income exclusion. This is one of the benefits that you get as a U.S. citizen living outside the United States. The foreign earned income exclusion allows U.S. citizens who are bona fide residents in a foreign country or who have a physical presence outside the United States to exclude up to a set amount of earned income from U.S. tax. Now, a bona fide resident is essentially a facts and circumstances case. We're representing a South Korean U.S. national in a tax court case in Washington in which the Internal Revenue Service refused to give this pilot who worked for South Korean Airlines in Seoul, South Korea, or at least from Seoul, South Korea, they refused to give him the foreign earned income exclusion, and the issue in the case is whether he was a bona fide resident of South Korea during the tax years in question. So it's a facts and circumstances test. Generally, anyone who lives outside the United States, has set up a home here, sends their children to local schools, etc., is going to meet the test. And certainly, if you're required to pay tax where you live, you're going to meet the test. The physical presence test requires that U.S. citizens live outside the United States for no less than 330 of any 12 consecutive 12-month periods. It's important. This is an absolute up or down test. 329 isn't good enough, which means that if you go back to the U.S., you came from the U.S., let's say, in the 1st of July, 2013, and you stayed in Greece until the end of February 2014, and you went back to the U.S. for 35 days in March and early April, and then returned to Greece, you can't start your consecutive 12-month period because you've already gone over the 30 days, so you're going to be very close to the 330. It's an absolute up or down test. 329 isn't good enough. 330 is essential. The days don't have to be in one tax year, as I've just demonstrated, but counting can be tricky, so you have to be careful. U.S. citizens working for the U.S. government in a foreign country or for an agency of the U.S. government cannot use the foreign earned income exclusion. All right, what is the exclusion? For 2011, it was $92,900, and for 2014, it was $99,200. Remember, the value of the exclusion is always calculated in USD. Now, this is where things get tricky with people who don't understand the concept of FEIE. It is earned income. That means wages, salary, commissions, bonuses, tips, fees, things that are paid for work. Consider it as active income. Interest, dividends, capital gains, rents, etc., are not earned income. I don't know how many people I've heard tell me, well, I earned less than $97,000 and so I don't have to pay any tax. Well, no. What if $97,000 was in rent? Right? It's not excluded. So there's a big misconception about the foreign earned income exclusion. Keep the word earned high in your mind. Okay. U.S. Social Security is not earned income. Neither is Greek Social Security income. Neither is pension income. If you're being paid a pension by an agency, an employer in the United States, if you're being paid a pension by an employer in Greece, it is not earned income, and it is subject to tax. So FEIE cannot be used to exclude U.S. or Greek Social Security payments, pension payments, annuities, etc. Now, both spouses in a working family can take FEIE. if they both work and meet the residence and physical presence tests. They don't have to meet the same test, but each of them has to be able to use FEIE independently. FEIE also automatically triggers the alternative minimum tax. When Congress enacted the AMT law in the 1960s, the objective was to make sure that U.S. citizens who were wealthy enough to earn income from passive investments that were tax-favored, like municipal bonds or lower interest tax bonds of certain descriptions, or took advantage of other what were called tax benefits, they had to pay some tax. And so the alternative minimum tax system was developed to ensure that they ended up paying some tax. AMT is forbiddingly complex, and the fact of the matter is it's impossible to explain. I think it's impossible to explain. Generally speaking, the AMT is calculated as if your foreign earned income was not taken. So everybody who claims FEIE has to file an AMT form with their IRS return. The FEIE can only be claimed. It's not automatic, okay? You've got to claim it. How do you claim it? Well, you file a Form 2555 or a 2555EZ with your Form 1040. Now, the tricky part is that earnings above the FEIE limit, so let's just posit a U.S. citizen resident in Greece earning 120,000 euros a year. When you convert that to USD, we now have roughly 138,000. Only 99 for 2014, 200 is excluded. So we have some income above the excluded amount. The tax you don't start getting taxed at $0. You start getting taxed at $99,201. So you go to the schedule of taxes and you start calculating your tax at the $99,201 level, roughly about 28%.